Next factor is what's called acceptability. So acceptability is concerned with whether the expected performance outcomes of a proposed strategy meet the expectations of stakeholders. Do we accept it based on performance outcomes? And there's three levels of acceptability, or three factors for acceptability. The first being risk. This concerns the extent to which strategic outcomes are unpredictable. Are we exposing ourselves to increased risk if we take this strategy? The second factor, well, kind of comes along with risk, is the return. What's the measure of the financial impact of a strategy? And we all know that risk and return sometimes go hand in hand. We can have high risk, but we better have a high return, if we go that route. And the third R is the reaction of stakeholders. Will stakeholders accept the strategy that we're proposing? And we know that when we measure stakeholder feedback or stakeholder opinion on a specific strategy, they're not all going to be in agreement. We have some stakeholders that will say yes and some that will say no. So this becomes a whole nother issue of, well, how do we assess knowing that some stakeholders may be more or less important? So the first is going to be the risk-return trade-off. We know this. If we want low risk, we better be ready to have low return. And what we're going to try to do when we assess risk is try to get an idea of, well, what's the acceptable level of risk that we've got? Well, there's a lot of risks to include. There's the risks of financial impact. If we take it, what are the risks that it doesn't pay off? What are the risks to the brand of a strategy? Hey, we can go off and launch a new product that maybe is not consistent with our brand. Will it pay off? Will our brand successfully keep its strength, or will we be damaging our brand and our reputation by seizing what looks like an opportunity in the short run but may not be in the long run? So there's three ways we can look at risk. Very simple. The first is going to be what's called a sensitivity analysis. So a sensitivity analysis is basically a series of what-if analyses. So we'll look at things like profit. And profit will be assessed in the future based on a series of, assumptions, like market demand. Well, we're going to make an assumption that market demand grows by X% per year. We're going to make an assumption that demand for our product will grow by X% or Y% per year. Well, what will happen to profit? What will happen to revenue? What will happen to market share if those assumptions are not as good as we expect? What if they go down a little bit? What if market demand doesn't grow by 6%, but it only grows by 5%? Well, how sensitive are the end results if we change these factors just a little bit? And that's what's called sensitivity analysis. So financial risk basically refers to the possibility that the organization may not be able to meet the key financial obligations necessary for survival. Well, there's two good indicators here of financial risk. The first is what we'll call gearing. It's the amount of debt the company has relative to its equity, or the debt-equity ratio. Now, why is this important? Because debt payments are mandatory. If you take a loan, you have to pay a certain amount every month. Well, if you have too much debt and suddenly, let's say, for example, your revenue takes a hit for some reason, your performance isn't as good, and you still have to pay your loans, you're putting at risk your organization. So a high debt-to-equity ratio is an indicator that, well, you may be at risk. You may be, if you undertake a project that increases that debt-equity ratio, you're putting your organization into a situation where there's not a lot of flexibility. The second measure would be that of liquidity. How much liquid assets, what type of assets do you have? Can they be converted quickly into cash? Can they pay bills? If you don't have liquid assets, and you're not able to pay your bills or your suppliers or your distributors, you could be in trouble. So a project that is basically removing cash or not generating sufficient cash will increase the risk exposure you have in your organization. Cash is king, especially in startups. A third element here will be a break-even analysis. And a break-even analysis is basically asking the question, at what level of sales will revenue equal cost? And that's the break-even point. And these are based on, obviously, this break-even point is based on a lot of assumptions about costs, about volumes, about price. Well, what happens if we change the price, if we change the cost, if we change the volume to that break-even point? How many units do we need to sell to break even if costs go up by 10%? How many units do we need to sell, or how much revenue do we need to make in sales if the price drops by 2% or by 5%? If we find out we need to make more and more and more sales, well, we may be taking a little bit too much risk. The break-even may be tough to achieve. So break-even analysis. These are three different ways we can measure risk. Sensitivity, what if, looking at specific financial ratios, like gearing ratios and liquidity ratios, and break-even analysis. If we want to look at return, so we've got an assessment of risk, now we want to know a little bit more about return. Well, the return can be tough if we're a not-for-profit organization, as stakeholder interests can be very diverse. We're not all interested in the same thing. So typical metrics for a nonprofit could be the mobilization of resources, stack of effectiveness, are we fulfilling the mission, etc. Now, if we're a for-profit organization, there are four elements or four ways we can measure the return on a particular investment. And I'd like to go through these four basic ways, four basic families of techniques to measure return. The first being financial analysis, the second being shareholder value analysis, the third cost benefit, and lastly, the use of real options. So let's look at return financial analysis. Now, a quick note, the different methods here that I'm going to present will vary by industry. Some methods and techniques vary by industry, and certain measures are used in certain industries. And you can look at that in one of the examples I'm in the case study at the end of the section as well. So the first would be ROCE, return on capital employed. Basically, we're looking at profit before interest and taxes divided by the capital employed. What's the return on the capital that we're employing in our strategy? Is it earning what we want it to earn? That's the first one. A second measure would be a payback period. So what we're going to do is we're going to look at our initial investment in our strategy, let's say minus 10, and we'll look at, well, what's the cash flow, the net cash flow that it's generating every period as it exists. And we'll look at the length of time for the cumulative cash flows of a project to become positive. So if we've got negative 10, we've got positive 2, we've got plus 5 cash flow, we have positive 6 cash flow. Well, how long do we have to wait to pay back the negative 10? We've lost 10 here, suddenly we've made up 2, so we're at negative 8. We've made up 5, so we're at negative 2. Suddenly in our fourth year, wow, good, we've got a cumulative positive 12. We invested minus 10, so basically our payback period is going to be a little less than 4 total years to get to payback for this initial negative 10. So what's the length of time for cumulative cash flows to become positive? In this case, it's 4 years. Now, this is not a really good assessment because cash in the future, money out here, is not measured the same way here. if you give me $100 in today, that $100 in 4 years is worth, hopefully, I could have invested that money and made more. So it's probably a little different measure. It's not going to be 100 today. If you say, hey, I'll give you 100 in 4 years or 95 today, are those the same numbers? Well, maybe, because the interest I can invest in 95, let it earn interest for 4 years, and probably maybe make more than 100. So I have to look at the present value. And so then we get to what's called a discounted cash flow. And the discounted cash flow will look at basically the same thing. We're going to look at our cash flow of a project. But now we're going to take the present value of the cash flow over time. So we've got our initial investment of 10. In the first year after we invest, it earns us a positive 2. But the present value of 2 today is only 1.82. Using, basically, we've assumed a 10% rate. Present value of 5 in 2 years is 4.13 today. Present value of 6 is 4.5 today. 4.1 is the present value of 6 in 5 years. 3.1 is the present value of 5 in 5 years. And plus 2, present value is 1.13 in 6 years. So what we'll do is we'll take the sum of those positive cash flows realized today. So we'll take the present value of it. We'll subtract our initial investment. We get to about 8.78. And we can calculate then the return on this initial investment of 10. And we'll ask, does the discounted cash flow exceed the cost of capital, which is 10%? How much would the interest rate have to change to bring that net present value to 0? In this case, the rate would have to be about 32% to bring the net present value to 0. That tells us how sensitive this measure is. Be careful when you use this type of financial analysis. Strategic projects may have high degrees of uncertainty, so a lot of these projections are very, very uncertain. Secondly, projects can have spillover effects and other cost benefits that can't be isolated. There's a lot of things that are happening in a project, and some of the impacts that we're going to have won't just be directly related to the specific project. And assessments are only as good as the assumptions. Remember that. To get to these numbers we've got over here in our cash flow, we made a whole bunch of assumptions. And if those assumptions are bad, I'm sorry, the numbers you're projecting won't be right. As we say, garbage in, garbage out. The next way to assess return is through shareholder value analysis, or SVA. So we're going to ask, what's it worth to the shareholder? There's two ways to assess the return for the shareholder, either TSR, total share return, or the second one, the EVA, economic value added. To do the total share return, we're going to look at the change in the share price, the stock share. We're going to obviously add in any dividends that the shareholder would have received, and we'll calculate the total return vis-a-vis the price of the stock. Now, the difficulty with doing TSR is that the stock or the company must be quoted on the market to get to these numbers. So if we take an example, here we have a price per share of 100 at the start of the year. The price per share goes up to 120 by the end of the year, and we receive a dividend of 5. So we've made a TSR of 125 divided by 100, or 25%. Just makes sense. The second way we can assess the shareholder value is through economic value added. And here we want to look at the cost of capital and the cost of capital adjusted for risk. So we'll look at our operating profit after tax. Let's say it's 10. To generate that 10, we had to employ 100 of capital, but the cost of that capital was 8%. So the economic value added was, well, we have an operating profit of 10, but we basically gave up the opportunity cost of that 100 was the 8%. So we only really earned 2. I mean, again, this is getting back to the fact that I could have taken that 100 and invested it at 8%. So what I'm making in terms of profit better exceed what I could have made by investing that money. In this case, it does. The profit after tax is greater than what I could have made if I invested my capital elsewhere. So that's considered the cost, the opportunity cost of the capital we used. Again, careful with these measures. This is very shareholder oriented, and focusing only on shareholders tends to drive us towards short-run analysis or short-term types of analysis. Now, another way we can assess return is through cost-benefit analysis. And this can get really messy because really good cost-benefit analysis has to include intangibles. It has to go beyond basic costs and benefits. We need to ask ourselves, well, for example, imagine one of the benefits is improved customer satisfaction. How do you measure that? It has to, maybe one of the benefits of a strategy will be improved brand value. How do you measure that? How do you measure the impact of that? And so these are a lot of intangibles that come into our assessment. And this is why this is a very tough thing to do. It's also excellent exercise for managers to undertake when assessing the strategy. It's very tough to do, right? One of the tools that you can look at that was developed by 3 professors, Parker, Benson, and Trainer, very interesting tool called information economics. And they went through and define specific ways that you can actually go and look at a series or a list of potential tangibles and intangibles that will impact your cost-benefit analysis. And they've done that pretty well, and it's particularly good for applying to digital transformation investments and projects in organizations. And the last way is through the use of real options. And real options basically say, let's invest in a project, and to what extent does this project allow us to take advantage of options, of opportunities as time advances? Does a project basically allow us to seize potential changes as time advances, or is a project closing off potential opportunities for us? Is it giving us flexibility, or is it basically closing us in? So does this project give us a strategic option in the future as things change, or are we closing ourselves off, which basically closes off options? Good example here, the option to expand. Imagine you have a project that's building up capacity in excess of the expected level of output. You may say, well, that's a lot of capacity, but if we build excess capacity, then in the future, management will have the option, but not the obligation, to expand production. So a project, a strategic initiative or a project that allows us to expand capacity and build capacity provides us with a certain degree of flexibility. Now, maybe we'll say, well, that's a lot of money to put out there, but it also is allowing us to react quickly if the market expands. It's opening up this option. It's opening up the possibility to seize a strategic opportunity if it occurs. So this allows us to basically go step by step. We're going to look at a strategy and ask us, well, will it allow us to make or invest in a possible strategic option that we can take later on. And we have to consider the value of that. I mean, it's a real value because it's allowing us to be a little bit more agile, maybe in a very, very complex and changing market. And the last criteria of our 3 R's, risk, return, and reaction, is how our stakeholders are going to react. Now, this is a game of politics. This is where it gets really messy. Share owners are a concerned group of people, and your strategy may reduce shareholders' power in the organization. They're not going to like that. Bankers, as a stakeholder, will be concerned about risk and the ability to pay. If the strategy doesn't work, will we be able to pay our debt? And they're concerned about liquidity. Regulators will be looking at, for example, well, to what extent we're respecting certain regulations. And regulators play a key role because they can fix prices. And we have to be on good terms with regulators. Employees may accept or reject a strategy for various reasons, and obviously local communities and citizens. You know, we may think that a project that supports, for example, the development of wind turbines or a new 5G project or telephones is something that, hey, that's great, that's their strategy, but have we taken into consideration that maybe the citizens will be negatively impacted? And how much power do they have? So we need to look at the reaction of stakeholders, because stakeholders can make or break a strategy. So we've gone through suitability, acceptability, and last but not least, feasibility. So feasibility can be financial. Do we have the cash to make it happen? Where can we get the funds to make it happen? Can we do it? If we're a startup, can we go to an angel investor and get the money? If we're growing in our market, can we go to growth investors? If we're in a mature industry, can we issue debt? Can we get equity? Can we get retained earnings to make it feasible? Can we do it? Do we have the people and the skills to do the strategy? Can we do it? Is it feasible? Do people have the skills to deliver on the strategy? Can we recruit the people or develop the skills if we don't have them? Do we have the support systems in place that these people will need? Can we integrate resources if we don't have them? Can we build on the existing, and can we obviously integrate new resources? Feasibility looks at the basic question, can you do it? Do you have the systems in place? Do you have the people in place to make the strategy work? And a simple tool to assess this is also called the 6 boxes. And 6 boxes basically measure 6 items that can make or break strategic performance. And a lot of them, most of them, look at feasibility. Are employees receiving feedback? And are employees given the do they know what they have to do? Are we leading people effectively? Do people have tools and resources to make the strategy work? Are they rewarded for making it work? Do employees have the skills and knowledge to make it work? Do they have the physical and mental capacity to make it work? Are they of right mind? Do they want to make it work? Are they coming to work to make sure that strategy gets executed properly? All this goes into feasibility. If people don't have the skills, if people are not rewarded to do and to undertake this new strategy, it's not feasible. It won't work. We may want it to work. It may provide us with potential returns. It may provide us with a whole bunch of great things, but feasibility may just fall apart. can we do it is a very important question to ask of any strategic initiative. Can we do it? Is it feasible? And with that, we've come through our 3 criteria of evaluating our option. Does it fit with who we are? Does it fit? Is it suitable for our organization in its context, given its strategy, given its strengths, given its weaknesses, and given the current external environment? Is it acceptable? Is it too risky? Does it provide the amount of return we want? Is it acceptable by our stakeholders? And lastly, feasibility. Can we do it? Simple question. Some words of caution as you proceed with your analysis. Number 1, SAFE criteria may be in conflict. It is not black and white. You may have something that's suitable, but not feasible. You may have something that the stakeholders want, but maybe you just can't do it. You need to make some personal judgments. There's no magic tool that's going to tell you yes or no. It's going to come back and it's going to say, well, it's positive here and it's negative here. You decide. Secondly, seek strategic consistency. Feasibility is a really good example here. Feasibility, in many cases in strategy, we may have certain resources that we want, and we know we need to make a strategy work, but sometimes we're not rewarding people to do the right thing. So the people are there, the skills are there, but we may not be rewarding them to do what we want them to do. So feasibility kind of goes out the door. We've got the people, we've got the resources, but we don't have the systems in place to make it work. So seek strategic consistency. A right-handed strategy for a left-handed person just doesn't work. It all has to fit. Evaluate as you go. You'll learn more about strategic options as you advance. Don't be afraid to reconsider, evaluate, try again. But beware, your assessment of the strategic option will change over time. And lastly, in real life, all of this systematic evaluation should happen, but it probably doesn't. And beware of that. Beware of the fact that a very, very, very detailed, for example, cost-benefit analysis is sometimes not done. In many cases, strategic projects are, for example, undertaken, and we don't do what's called a post-mortem. A good post-mortem analysis should say, we undertook a strategy, we put it into place, and it didn't work. Well, we should analyze why it didn't work, because that's going to give us a really good assessment of the assumptions that we had and whether they were right or wrong. Unfortunately, postmortems on projects and strategies are rarely properly done. So there you have it, some basics of strategy evaluation, the importance of understanding the criteria, of SAFE criteria, the importance of understanding financial and non-financial assessment of projects and strategy. You've seen an overall. I think you've also seen that it's not as scientific as one would hope. Successful evaluation of strategies does rely on a lot of personal judgment, as I've mentioned here. So keep that in mind. Good luck, and I'll see you next time.